much, Nicholas, for the introduction, and also to Capital Link for inviting me back again. As Nicholas mentioned, my name is Jasel Chauhan. I'm a partner at Holman, Fenwick, Willan, based here in Piraeus, specialising in ship finance and corporate shipping. As always, it's a pleasure to moderate the banking and ship finance panel. And certainly it's a particular privilege this year to have such a strong selection of panelists, which I think is really testament to the importance of the Greek market, and it's very nice to see that that's there. To briefly introduce the panelists, we have Michael Parker from Citibank, Richard Jansen from Deutsche Bank, Henriette Brent-Petersen from DVB, and Carsten Wiebers from KfW. And I think without further ado, we'll get on to the interesting part straight away, and I'll start with the questions. As usual, we start with an overview from the bankers of how they saw the previous year and what the bank sees for the year to come. To add some context, with historic lows month after month, economic slowdown in China, depressed oil prices, and very little optimism by the end of last year, is there any good news? How would you sum up 2015 for your bank, and what do you expect in 2016? Michael, would you like to start?
2015 was a very good year, and in fact for Citi as a whole, I think it was our best year since the crisis. And in our shipping franchise, it was a record-breaking year, but obviously our franchise is a global franchise, and so I look at it in that perspective. Activity may have been slightly less than the year before in Europe, but there's a lot still going on in Asia. I think 2016 is much more difficult because the things that no doubt the panel are going to talk about, but the pressure of the markets, the pressure of the regulators, and fundamentally the underlying markets, particularly those either driven by the low oil price, so the offshore market, or the dry bulk market. The combination of things makes for this year, which could be a perfect storm. Now, that is things that all of us on this panel have to address on a day-to-day basis. In the context of the industry overall, though, I think 2016 for Citi will be another good year, because fundamentally shipping as an industry continues to be a key part of the global economy, and the global economy continues to function. One of the important things about shipping is it doesn't face some of the existential threats that maybe industries like the auto industry does from Google. We don't have a technological challenge that maybe they face. So I think staying focused around what our clients are doing and their need to raise capital, their need to do strategic things, I think 2016 will be a very active year for us, but I don't underestimate the challenges that the three things of markets and regulators and general economic depression will inflict on all of us.
Richard.
Thank you. Well, similar to Citi, Deutsche had quite a decent year in 2015, albeit that we obviously wrote off 12 billion in order to take care of some legacy issues. But if you looked at the top line, it was certainly a good year. And at Deutsche, we were clearly looking forward to 16. And then we all went on Christmas holiday and returned and figured, what did we miss in the meantime? The first 6 weeks of 16 have been quite challenging, to say the least. From a shipping franchise perspective, 2015 was a good year. We expect that 16 will continue to be a good year. But clearly, as Michael says, we are facing quite a perfect storm, which is challenging. There is no other word for it. We find it quite difficult to have any sense of direction or bearing, in terms of trying to anticipate what will be the best approaches for both our customers as well as our own portfolio. So for the time being, we take it one step at a time and keep a level head. We remain open for business. We are selective, yes, but across the board, we are there to assist and help our customers.
Yes, thank you. Focusing on the markets, if we look at, we all know the challenges we experienced in 2015, but I also think that 2015 changed the perception of many minds in our industry and geared us for what is awaiting in 2016. And I think what we have all been used to is excess supply driven by too much shipbuilding capacity, excess liquidity, and more listening to research perhaps also, so people are acting upon a rebound with speculative investments in our industry. But I think 2016 and going forward, we will focus much more on the game changers happening and that we saw in the container industry, we saw in the autumn of 2015, but the fundamental changes that we see happening on the demand side, which will lead to our shipping industries emerging from the crisis in different ways. So that mindset change in the industry, I think, is also what allows us to look forward and to start to focus on the various shipping sectors, perhaps with a different mindset, and not seeing all shipping sectors with the same glasses. And I believe that also 16, in the end of the year, will start to represent significant market opportunities when you look at the market outlook, which may be difficult to understand in today's market. But in some sectors, for example, the dry bulk market is perhaps also the industry where we see a sector coming back to traditional shipping cyclicality as we know it. As some of you may know, we have been arguing that shipping sectors are out of cyclicality for a while, but the mindset change is also leading that we are coming back to the traditional cyclicality in some subsectors.
Thanks. Henriette, before we actually move on to Carsten, I want to just draw out a few of the points there. We've heard a couple of terms like perfect storm, but and game changers and tough years, but there was definitely a positive edge to some of the things you were saying, and I just want to develop that a bit more. And I mean, on the basis that there is potential for this year to be a very tough year, is that also a positive in the sense that perhaps after this year there could be more opportunity, or actually getting through this year will show then a change or a game changer after this year? Is there prospects for that, or how do you see things beyond 2016?
Definitely, but I think, as I said today, it's important to look at the structural changes happening on the demand side in most shipping sectors. They're not the same. They are so different, and it's so important to translate that down to the respective outlooks, not only in each sector, but also in the subsectors. What we see happening in the dry bulk market today is that subsectors will emerge very differently from what we have been used to. We see also, not using the word cascading in dry bulk, we see very large vessels coming in, putting pressure on the capes. We also see that the demand is hitting perhaps mostly on the capes, the slowdown in the demand driven by the Chinese slowdown. So we will see that some subsectors in dry bulk, we already now start to see opportunities, and by the end of the year, I believe we will start to see more opportunities. That being said, we still have a lot of excess supply that needs to be absorbed before we are talking a real strong rebound. Mm-hmm. If we're looking at the container market, we are more arguing that it's a correction. We have for several years seen that every tow entering the container market only put 60% pressure on the market due to the low utilization of the very large capacity coming in. In dry bulk, every single deadweight tow coming into the industry put full 100% pressure on the industry. So we have seen in the autumn the release of a lot of hidden capacity, which is now cascading down through the sector. And that is what we see it, a correction more than it is volatility. It's a correction towards a more fundamental equilibrium. In the tanker markets, it's a different story again. It's a global energy picture which is changing dramatic at a rapid speed. We see that temporarily benefiting the crude market, but perhaps more sustainable on the product tanker market. So today is also we're not just looking at excess capacity. We are looking at excess capacity across shipping sectors, but tomorrow it's a different picture.
Okay, thank you. Carsten.
Yes, thank you. Well, also for the start, looking back, just like for the others, 2015 was an excellent year for the bank, KfW Ipex-Bank, as well for our department, Maritime Industries. We arranged record numbers and kept quite a bit of it in our books. Coming from Germany, being a German bank, I might note that we had digested any KG portfolio issues in 2013 already, so we enjoyed good results now for 2 years, and whatever our legacy issue there has been digested. Now looking at 2016 and ahead, I think we come to realize that we enjoyed a very special economic situation, what was maybe the last 15 years. It was kind of having a daily high energy drink out of lots of caffeine and sugar, and if you have too much of it, maybe end of 2008 we had a kind of heart attack from that, but the party moved on for quite some time, and the ingredients were what we believe the low interest rates, the free money, plus the exceptional economic expansion of China. And the later one comes now to an end with respect to its full power. So we expect more to come back to growth rates which we maybe saw in the 90s. So instead of having your double espresso with lots of sugar in the morning for lunch and in the evening, maybe we are coming back more to the chamomile tea we had in the 90s. And to add a bit flavor to the panel, rather than thinking of the perfect storm, which sounds quite exciting for this year, maybe we have to get used to more moderate levels. After all, chamomile tea is not that exciting, but maybe better for the heart after all. So our expectation is that things will become more moderate, and we will have to get used to lower growth rates. We do have a rather diversified portfolio. And as mentioned before, there are still lots of opportunities in what floats at sea to finance and to support owners in the various niches you will find in the various maritime markets to invest and to finance. That's basically our outlook for 16 and ahead.
Thank you, Carsten. And I think moving on, and I think coming back slightly to the ship finance aspects and how that will change in 2016. I think one of the areas coming up was obviously a couple people mentioned about legacy portfolios and debt write-offs as well. And certainly over the last year, over the last 5 years, the traditional shape and nature of the ship finance market has changed quite a bit. And I think on that point, I'd ask how the panelists see the banks and ship finance market developing in 2016 and beyond. And one of the trends that we have started to see is traditional Western European ship finance banks perhaps reducing market share and potential new players filling the gap. And I think both linked with how much available finance will there be and how will the shape of the traditional ship finance change. I think it would be interesting to hear the panelists' views on that. Would you like to?
Yeah, I mean, I think the demand for new money isn't nearly as much as it was, but part of that, and the big, I don't want Carsten to lull you all into a false sense of security and calmness with your chamomile tea. There's a man in a black cloak carrying a scythe, normally known as a DEF, but in terms of banks it's called capital or regulators or compliance, whatever you want to call it. And the great shadow of regulation and how we manage our capital hangs over us. The American banks went through the crisis in a sense much more quickly, though even in the US the regulators continue to change the rules and add requirements, so that it's not over there, but obviously Europe is a little bit behind. And clearly European banks face the asset quality review this year, and I think that's the question you should ask the European bankers on the panel, because the 2014 AQR was not as thorough as it could have been, because of course it was the first time, and standardizing all the Eurozone banks in terms of how they assess risk and how much capital they have against the same sort of risks was not really possible. The plan, as far as one reads, is that the AQR for this year will be much, much tougher. And of course, that requires banks to position themselves for passing those tests. And therefore, it seems to me that in high-risk portfolios, clearly, the need to make sure that the quality of those portfolios is as high as possible will influence the amount of money they're willing to commit. That said, I think there is also a flight to quality, so the best names in the industry will continue to attract banks and continue to attract capital. But the one thing we have seen is that capital, for the first time in the last couple of years, has been priced competitively and properly in the industry for the first time, certainly in my 30 years as a banker to the industry, finally seeing the cost of capital being truly competitive in the sense of assessing against the quality of the risk being taken. So the money is there for the right things, but I think the situation facing banks probably is going to be far more important this year in not just shipping, but shipping, given the state of the industry, will be particularly affected, I think.
Thanks, Michael. And I think that's raised an interesting point, which I think we'll discuss a bit further in terms of bank regulation, capital requirements, and how that itself has an impact on shipping, ship finance. But as you said, moving on to the European and German banks, luckily or unluckily for Richard, Deutsche Bank seemed to have been in the press quite a bit. There was even a mention in the first presentation. So I'd ask Richard how he sees the European ship finance developing, and perhaps even a more closer to home question, and addressing perhaps some of the rumours that seem to have emerged about the very potential of Deutsche Bank leaving shipping, perhaps, if you can comment on that.
Well, to answer the last question right away, I've heard the rumor as well, but I wouldn't be sitting here if we were exiting the building. What I think is clear, and I think Michael alluded to it already, is that we as banks are continuing to face mounting regulatory pressure for both capital, but just also in structural elements in terms of how we effectively transact with our customers. And in light of the asset quality review, the guidance that we are getting, the guidance that we are seeing is that, for example, something that may sound or look trivial is an advanced approach, meaning that you can, because you hold the first mortgage on an asset, can actually apply less capital and therefore still make relatively good return on equity, despite what I still consider as relatively low pricing for the risk in shipping, in the shipping industry. Compared to other types of hard assets that Deutsche finances, that sort of methodology is potentially going to go away, and that the regulators are saying, well, it's interesting, you're arguing that we should have better capital treatment because these assets are liquid assets. They can be liquidated quickly, they can be turned into cash, and they have a certain value, a certain base value. If you try to argue that in today's environment, for example, for dry bulk vessels, a regulator very simply has a much stronger case than you have as a banker in terms of arguing a certain base level of values. So in reverse, the next question that comes from your regulator invariably is, well, how about your capital treatment? And quite frankly, we have to then agree. So we expect that this will be a continuing issue. That will mean is that banks will have to hold more capital. If we hold more capital, financing will be either less in volume or the pricing will go up. Fairly simple. Now it can be then the total volume in the industry then can be taken up by other banks. I've been in the industry not as long as Michael, but you have your core banks in the shipping space, and you have your tourist banks, if I may deem them like that. There will always be a few people that find it a new right time to enter the industry, and after a few years they realize it's much tougher to be in the shipping industry than they thought, and they will leave again. So, by and large, quite a few regulatory challenges, but by no means anything that is detrimental to Deutsche nor to our shipping franchise.
Thank you. Yes. And Henriette, I'd just like to kind of take your views on how you see both maybe ship finance developing, but also how the banking market has its own pressures and develops, and itself impacts shipping as well.
Yeah, maybe one last comment to what Richard said in terms of new players will enter the market and find out that it's a challenging industry and perhaps exit earlier than planned. I think we're already there. I think the attractiveness of our industry has decreased significantly during the last 5 years. And we saw all the speculative investors coming in after 2008 wanting to ride the cycle and make an asset flip or an IPO and exit with a huge gain. I mean, that everyone realizes that is not happening. So the attractiveness of our industry, we are already there, so to speak, that we're not that attractive. And second, on the regulatory side, yes, we get a tremendous amount of questions and very intelligent questions. There's no doubt that the regulators knows our industry into a detail, for me it's a pleasure to discuss the markets and the way we balance our portfolio with the regulators. But there's no doubt that for European banks we are faced with an enormous amount of questions, interference, and demand in terms of constant having to answer questions. And of course it's time consuming for a bank. It's putting a lot of strain to the resources that we would perhaps prefer to apply to something else. And what was the last part of your question, sorry?
I think to focus that view of the market, and I think the pressures on banking and how that specifically affects shipping, I suppose it probably adds to part of that perfect storm of a mix of the pressures on shipping and the mix of the pressures on banking. Is that your view as well, or?
Yeah, the pressure is on understanding the portfolio and risks that lies within the portfolio and the opportunities going forward. And as Richard said, liquidity of your portfolio is also being questioned. And therefore the composition of your portfolio, not only within sectors but also within the sectors and subsectors and quality of assets, etc., etc. It's the in-depthness of the question which is impressive.
And Carsten, I think it's become a bit of a two-pronged question, both in terms of how you would see the ship finance market developing, whether with existing players or new players, but also how you see the banking market developing with the increased pressures on banks.
Well, first of all, I think the key question probably for the audience is, will I get the money I might need, right? Rather than our internal problems, which, every industry has their own internal problems with their own regulator. So I think there will be enough money for those who still want to invest, because after all, there's only too little money if there's more investment than there's finance available. And since the overall amount of investment is going down significantly, the question is only, will there be for the remaining investments enough money? So it's true, many banks have, or several banks have exited or are not able to really lend the same levels. But considering the reduced investment, I think there's still enough lending capacity around. After all, we are still in competition, and when I see even in the last 2 months what offers there are at the table and what competition we are facing, I don't see any scarcity whatsoever of funding available for ship owners.
Carsten, sorry, on that, would you agree with the statement of there being less volume and higher pricing?
Less volume and higher pricing. Well, again, this is a two-split market. Of course, our industries operate in US dollars, and the funding costs for European banks have gone up. Now, the American banks luckily have direct access to the tap, so they still get the cheap dollars. The European banks don't. So funding cost has gone up, and with it, the pricing. It may be also that pricing went up a little bit beyond that because the banks have realized that cost of risk may be higher than they would have liked to admit. So, but all in all, even with the increase, the slight increase in LIBOR and a slight increase of funding cost, maybe charging for cost of risk, money is still very cheap. So all in all, I think we would probably have to see much higher interest rates for the markets to calm down and to avoid speculative ordering. There will be still too many tempted, if on a variable basis they can lend money at 2.5%. Too many will be tempted to borrow. Now the banking industry at large, well, first of all, I agree with the others. Shipping is under scrutiny by the regulators at large. Shipping itself is a tiny industry compared to the overall industries the regulators are monitoring. But if the regulator comes to us, comes to the other banks, the first thing on the agenda is always shipping, even though it may be only a small portion of the overall portfolio. Several banks went under or had to close that part of business due to the problems they have in their shipping portfolio. With respect to the overall, I can only repeat what was said. You have to consider in the past there were banks with core capital of 4-5%. Now core capital requirements rising to 15%. Just imagine you have to triple your equity within short. And if minimum equity requirement is now 15%, you may want to have a buffer, which at the end of the day, it means you may want to have 20% equity in your balance sheet. And in order to achieve that, you have to very carefully think how to spend your money in terms of lending or other products. And that is putting pressure on all of us to more selectively choose with whom we are doing business and especially what structures we choose. Because under Basel II, the temptation was in good times, the values were high, the ratings were good, we had to set aside only very little equity, which resulted in a very cyclical market in enormous equity requirements for the banks when the ship values went down and the ratings also went down. So shipping had become a roller coaster in the bank's balance sheets. So therefore now we're asking for lower leverage, maybe more ECA cover, stronger corporates, flight to quality as was mentioned before. And that creates some tension between the lenders and the borrowers we may not have seen 10 years ago.
I don't think bankers are used to being on panel quite so early in the morning, so we're not really addressing the question that I think a lot of you want to ask. I mean, I thought the mid-'80s when I came into shipping finance was going to be the worst, and I don't think it is. I think we're now about to go into the worst year probably since then. The other sources of finance have dried up. Now, this afternoon you can ask the investment bankers from New York, when the equity markets for shipping will open up again. I think the debt capital markets are open for some people, but the liquidity that came in through hedge funds and private equity does not appear to be there anymore. Obviously, a lot of it is there and still stuck there. But this time last year, in a hotel just up the road, everyone that had been buying shipping distressed debt had run off to buy shale oil distressed debt. The liquidity had moved, if you like, to a different sector. And so if there isn't the alternative sources of finance and there is the additional regulation, and leverage by the instructions of regulators needs to be lower, what will happen when covenants get breached? And I think this is the year, there is no can left to kick down the road because the can has been removed by the regulators from the field. And so I think this is the time where relationships may get tested and where regulators will force banks to take very difficult decisions whilst there is still value in the security they hold against their loans. So I think this is the year where we really are going to see some quite tough decisions being made by banks. Already we see some of the leading lenders to the industry behaving differently. And I think that is going to have a knock-on effect. So the two-tier market is really those that have no difficulty because they're very liquid, they're very lowly leveraged relative to others. They will have no difficulty, I think, continuing to raise money. But there is a large number of borrowers out there, particularly in those sectors under pressure, where the traditional extend and amend and extend, or whatever you want to call it, I think will be much more difficult, because this time the regulators will be making banks recognize those decisions. And if you are a risk person that has no emotional attachment to the industry, and you're presented with a dry bulk market and an opportunity to get out at 100 cents on the dollar when there's a breach of a covenant, are you going to take that decision now, or are you going to run the risk that the security you hold may be worth half of that within the space of 6 months? Those are the very real decisions I think we have not truly had to face in the last few years that we will face this year. So I think this year the perfect storm element is going to be around some of those difficult decisions which banks face.
Thank you, Michael. And on that, one of the topics that you mentioned was obviously the nature of restructurings, potential of the end of the extend and pretend era. But to come back to that, I mean, one thing that I have started to see is actually a bit of a mix as part of restructurings, also looking to take some of the opportunities, the positives that are there, that potentially now, where there is sufficient capital, it may be a good time to combine restructuring, reprofiling with potential acquisitions where certain markets are at an all-time low. Now, I throw that question out to the panel in terms of, is there still a positive edge to what is something that can be ordinarily very tough, that looking at opportunities as well as the restructuring part? Richard, would you like to?
I think generally, I think Michael put it very eloquently. There's going to be a complete change in the discussion in 2016 between banks and customers. There is definitely a bifurcation in the market between the higher quality type of credits, where you might be able to take a little bit more of a back seat for that company to get through this difficult cycle. But banks are going to have to be more proactive in the way they deal with problems. So extending in the name of relationship is a sentence that I cannot explain to a regulator nor any sensible credit person these days. So it's nice, we'll have that discussion for 5 or 15 minutes if you want, but at the end of the day, we're going to have to go back to business. And it's I liken it to a doctor telling somebody he or she has an incurable disease, or at least a very bad disease. You're not going to postpone taking the medicine, are you, if it's concerning your own personal health? So why do we as banks regularly have to have the conversation with our customers about postponing taking the medicine? It's a very difficult conversation. In this environment, at the same time, banks are willing to help, and we want to be creative. So if creative means, to your question, averaging down by acquiring additional assets at this low point in the cycle, we have nothing philosophically against it, provided you're also able to support that. So if you think that we're going to be financing 100% of you averaging down, then we're going to scratch our head and go like, well, who's now the equity in this particular equation? And if that's us, then we should deserve 100% of the upside. But usually that is not a conversation that seems to lead anywhere either. So, long story short is there is a number of dances that we can do. I have a tape recorder with me with various little genres, but very few end up somewhere different.
I agree very much with what Michael just said. I think we are there now. I'm constantly being asked, but we are at the bottom. We are at the low of dry bulk. I said, no, we're not. It's going to get worse in 2016 because it has to before. And it's driven by all the arguments that Michael just presented, saying that we will see a lot of change in ownership, in especially the dry bulk market in 2016. But this is also what it takes before we start to see the rebound materializing in the dry bulk market. And that also represents this challenge to the industry throughout 2016 will also represent the opportunities for the players, the strong players, with a demand for tonnage with access to employment and cargo.
Okay. Thank you, Henriette. And Carsten, last few words before we throw the questions to the floor.
Yes, well, I would see a benefit in restructuring and buying loans only if you believe that what you buy you can has a higher value in the future. And since we all agree that the markets are still rather inflated, I don't think you can expect to gain any money out of buying distressed debt or dealing with such borrowers. And since our equity, our money is scarce already, at least for ourselves, we are not going to buy up restructured loans even at 10 cents to the dollar, because we want to use the remaining resources we have for our existing customers. So therefore, restructuring, I don't see anything positive in it. It is dealing with the past, the mistakes one may have done. You have to get through it. You have to be able to digest it and keep tight and see what you can do with the remaining assets you have.
Thank you. I think hopefully we'll just have a few minutes for any questions from the audience. I think before going to that, we've heard the terms perfect storm, the worst year since the 80s. Difficult conversations, and it's going to get worse. So if there's anyone brave enough to ask a question, we can see. Any questions? Yes.
Mr. Tlavlevis does not need the microphone, but anyway.
Thank you, Nico. First, one question I want to ask. I don't know which one of the panel would like to respond. Don't forget, banks for a number of years have played the game of musical chairs. And quite frankly, I think it's quite disappointing to find that now that we're going to go and face perhaps the opportunities which we haven't seen in shipping, I'd venture to suggest since the Second World War. The slump of the early 80s was nothing in comparison to what we have now, for the simple reason that during the 80s, there were a lot of banks around, and there's a lot of reshuffling of the cards, and perhaps a lot of massaging of the loans which one could adopt. But on the unfortunate situation now with the lack of funding for the banks, I'd say that perhaps instead of mentioning about how there's gloom and doom, I'd like to suggest that this is perhaps the chance and the opportunity of the century. And my message goes to the younger generation to be daring, have faith, have stamina, maintain your childish enthusiasm. Don't go by logic, because we've seen what logic has done so far. Go by your inspiration, your hunch, and your gut feeling. Because I feel that we're not going to see gloom and doom. For those who can hold their horses and maintain their resilience and their calmness, we are going to see the best opportunities we've seen this century. Thank you.
A very strong case for optimism. Any takers?
Well, in answer to that and to the question you asked, there are opportunities for people, but I think that the rules have changed because the banks, whether it was the banks, whether it was weak regulation, whether it was politicians, whoever you want to blame for the crisis, allowed a financial crisis to get out of control, and we therefore see the consumers, the taxpayers, the voters in many Western countries decided that they did not want to have to bail out their banks again. So there's a regulatory reaction to that that we all have to deal with. One of the problems for the shipping industry is that shipping never paid the cost of capital. Its capital was always far too cheap. If half the people who ordered ships could ever have justified why they ordered a ship, then there wouldn't have been the same amount of money that went to fund those ships if the cost of capital had been correct. So one of the problems is we have this huge excess capacity, which is just going to take longer to absorb. If you look at any chart out of Clarkson's or whatever and go back over 20, 30 years, the huge growth in the world fleet, of course, China, a very large part of that. But, the ordering of ships has created, a problem. And of course, as Peter Dukas referred to, there's a huge debt problem sitting with consumers in the world. So absorbing that debt, and shipping is just part of us having to absorb all that debt. And so I don't disagree with you. There are opportunities there, but I think you'll find that they won't be talked about by banks on panels because we'll be talking about some of the other things we've been talking about. But of course, we'll also secretly be trying to do some of the deals that you suggest are there. So, but it won't be, the happy banker sitting on a panel promising everything to everyone. You'll have to wait at least another 25 years, I think, before that will come back. 5 seconds.
Yeah, no. I think the word
He is
secret
government owned, by the way.
was the key. I think you're fully right. The problem is if everybody believes that, it will never happen. You see, we have seen it in the container market, right? So 5 years ago or so, everything went down, and then people saw the opportunity. And if everybody thinks it comes up in 3 years, it will never come up. So my suggestion would be, if you're optimistic, keep it to yourself, don't tell the others, and we might talk about financing, So.
I think on that note, we're pretty much finished for time, and I'll hand back to Nicholas.